we'll start off with a description of what PACE is, because at this conference I personally have had several conversations with people who seemed excited about PACE but literally then said, what does it stand for? And it stands for Property Assessed Clean Energy, of course, and it's a way for, instead of taking out a mortgage to finance an energy upgrade for your facility, you can agree on a voluntary basis to pay higher property taxes. That obviously has dramatic credit implications, but it's a way to promote clean energy in the United States. It started in California about 9 years ago. The technique for doing this voluntary increase in property tax has been around since the mid-1800s. So like most people in finance, every time we think we've invented something new, we find out it's like 200 years old or 100 years old. I'm going to invite Cecil to finish the discussion of what is PACE. What is property assessed clean energy? Is it residential? Is it commercial? What is it? And then after we finish introducing the subject of PACE, we'll introduce ourselves.
Hi, good morning. I'm Cecil Smart. Just to expound on what was briefly touched upon there with regard to PACE, property assessed clean energy. It's not limited to just energy. You'll see installations on properties, residential and commercial, for water conservation. You'll see it for seismic retrofits. You'll see it in other states for storm hardening. So it's a function of the jurisdiction, not just energy conservation. And what it is generally 100% financing that accommodates the installation of the things I just referenced. And the actual obligation stays with the underlying property. So if the homeowner or the occupant of the property in the commercial PACE instance decides to move out, the next occupant of that property is on the hook for the actual taxes that get assessed on the property that relates to the installation. The originators that originate PACE cannot place taxes on the property by themselves. No private entity can do that. So they partner with different municipalities / counties via this joint powers of authority construct that allows them to tax the underlying properties via this relationship.
Thank you. Why don't you follow up with just introducing yourself to our colleagues?
Again, I'm Cecil Smart. I'm Managing Director at Kroll Bond Rating Agency. Kroll has been involved in the first PACE ABS issuance back in 2014, has rated every senior transaction since. I believe that's around 20 transactions. Some of those transactions have commercial properties in them. And now you see that as of the most recent ABS issuance, they've only been, for the most part, residential, but we're having conversations with different commercial PACE originators where we're going from a granular portfolio where we have thousands of residential properties where people are contemplating doing single property commercial PACE where the property is being rehabilitated. So there isn't actually an occupant of the property, and they're using commercial PACE as a way to replace the equity requirement in the capital stack. So it's actually morphing into different ways to finance different projects at different stages.
Great. James?
Hi, I'm James Vergara. I'm the head of capital markets at PACE Funding. We're a residential PACE provider in California and in Florida. I've been involved in PACE for about 5 years now. I was at Deutsche Bank for a while, and then after Deutsche Bank was at Spruce, so in both of those places. Started up 2 PACE programs, and here at my 3rd.
Good morning, my name is Tom Knox. I'm a partner in PwC's Los Angeles office, and I provide services to PACE clients, both commercial and residential, and look forward to our discussion today.
Thanks, Tom. And I'm Steve Kervorst. Again, I'm managing partner of Lord Capital. We're an alternative investments manager, and very excited to have a fund dedicated to commercial PACE. Tom, I'd like to start with you. Can you talk about PACE disclosures and other things that an accounting firm would be focused on?
Sure. I mean, I think as we talk today about regulatory developments, it's interesting, I think, and important to put, Stephen, as you said, the very young life of this industry in the context of some other asset classes in the securitization space. And so, for example, when mortgage-backed securities first started to be issued, there was a patchwork quilt of different regulations that tried to protect the interests of the homeowners and the interest of the borrowers, the interest of the servicers, and ultimately the interest of the investors. And it was a slow progression over the years, but over time in the residential mortgage space, for agency loans, Fannie, Freddie, Ginnie, HUD, there wound up being those agencies driving, an audit program, which we call now the HUD Chapter 6 and HUD Chapter 7 audits, where those organizations are overseeing the activities of the servicer and making sure that they're in compliance with a set of standards established by those servicers. In the non-agency space, along came an industry group called the Mortgage Bankers Association, and they tried to fill a gap in the market in the non-agency space by creating a regulatory framework called USAP. And USAP, for those of you that have spent any time in the residential mortgage investment or securitization space, was kind of the bread and butter oversight or compliance report for non-agency mortgages. And then in 2006, our friends in the SEC gave us Regulation AB, which is the regulation governing not only the registration of asset-backed securities, but also the ongoing servicing and the oversight of those. And that includes an annual servicing attestation report that the servicer and accountant firm make and actually include on the 10K filing of each public trust. So let's compare that to where we are, 9 years into the PACE industry. We don't have a large regulatory framework. We don't have a large government presence like the agencies. There's no Fannie, Freddie, or Ginnie of PACE. And so there's not that organization to create any kind of regulatory framework. In terms of the industry advocacy group, there's a relatively new PACE Nation industry advocacy group that has been organized that's starting to get some traction in terms of some industry best practices and standards, and I think that we'll talk about that a little bit later and how important that is for this market. And in terms of the SEC required transactions or oversight in terms of Regulation AB, most, if not all, of these transactions are private 144A transactions and therefore not subject to Regulation AB. So I think from an accountant's point of view, while we do the same work on the issuance side in terms of the due diligence report filed on 15G and the non-due diligence report that provides comfort to the underwriters in terms of the accuracy of the disclosures in the prospectus, there's not really another one of those oversight kind of report or servicing reviews. But I think it's a lot of discussion in the industry in terms of what should be there and what should that look like. And so that's what I hope that we can talk more about today.
And people like PwC are interested in establishing standards, right?
I don't think it's up to the accounting firm to establish the standards.
Okay.
I think that we very much look to the industry to establish those standards for themselves.
Are those standards national standards or state standards? Because I want us to talk about why state legislation is what we all rely on.
Right. So the standards are national, but for example, in the mortgage space, they're oriented around certain constituencies, right? So for the agency constituency, it's the Chapter 6 and Chapter 7 reports. For the publicly issued securitizations, it's Reg AB. For the privately issued mortgage transactions, it's USAP. So I wonder if PACE will wind up with a bifurcated approach like that, or whether we'll have a single set of consistent national standards.
Given the fact that there are almost no losses in the history of PACE, in the entire history of the industry, there's almost no losses. There's a tiny handful of defaults when it comes to commercial PACE. What about residential PACE? Is that what's attracting all this legislation?
I don't think it's necessarily the losses that's attracting the legislation. I think it's the articles that we've all read in the Wall Street Journal in terms of a homeowner being harmed because they didn't understand the product, they didn't understand what they were signing up for. And I think that that's the focus of the regulatory oversight right now, which is, how do we make sure that the right people are getting these loans, that they understand the terms, that they understand how it's different than a mortgage, that it's not portable, with you, it stays with the property. And I think that that's the focus of the oversight right now.
There seems to be a vendetta from Fannie and Freddie and everybody else against PACE. I think yesterday there was some discussion that, I'm sorry, I don't have it in my notes, some discussion from the FHFA that they're going to take extremely close scrutiny of anything related to a PACE lien or any mortgage related to a PACE lien. Other people have come out and said, we're not providing mortgages if there's a PACE lien. Is that hostility sort of warranted? Because what you really have is quasi-government entities saying we don't want to promote clean energy. Does anybody in the audience want to take a stab at that? So let's talk about the effect of legislation, because the legislation is basically to react to abuses that can take place in any, quote, retail activity where, in worst case, grandma gets defrauded and she's paying higher property taxes. She doesn't know why. The installation of the solar panels or weather hardening or something never happened. What happens? Is that a risk? Does that mean that the PACE loan repayment is in jeopardy?
So maybe I'll start, Steve.
Okay.
And again, it's James Vergara from PACE Funding. I think both Tom and you have pointed out that sort of the key driver of this latest round of regulatory improvements is really to add additional dimensions of protection for the consumer, for grandma, as you mentioned. I think by and large, it's in kind of three very broad categories. One is just better business practices, some standardization in terms of, the amount that you're allowed to finance, some standardization in the training of contractors who primarily serve as our sales forces, as well as removing the ability for a financing provider to pay economic incentives to contractors that are offering our financing. So I think that's sort of on the better business practice front. We also are adding the dimension of income and affordability to the underwriting criteria. So again, to try to protect, again, that particular group who, again, may have a lot of equity in their home, pay their taxes, pay their mortgage, but not necessarily have the disposable income to pay for an increase in their property tax bill. And then lastly, we're also in California bringing on this oversight from the Department of Business Oversight to really create a regulatory body and a regulatory framework to license and enforce business practices in the PACE industry. So I think all of this is improving on what we already have as strong consumer protections in our industry, again, to respond to the headlines, to respond to the failed class action lawsuits, and really lead to an expansion of our market, beyond the states where we have residential PACE now.
So California is proposing legislation to affect PACE. What are the chances that Missouri would follow that legislation, the Show Me state?
Well, so California's already passed it, right? These are laws that were enacted and signed by the governor. I know that in Florida there is a version of this legislation that's working its way through Tallahassee. There is certainly some, what's the right word? California leads, right? We're very proud of the fact that California is always at the cutting edge of technology, but there's definitely some, maybe resentment is too strong a word, but I think having a body like a PACE Nation or an industry group that could be the sponsor or put together a framework for this legislation may be more helpful in terms of broader acceptance than just pushing California's rules on everyone else.
So basically the PACE market over 9 years is building a critical mass now to have an advocacy that might make a difference.
I think so.
Another way to say that. Let's talk about the cost effects for a minute. Generally, increased regulation means increased costs. You have to have training. You have to have, when somebody would you just talk about the sales process? And the legislation now calls for training for example? How does that factor into, what is the process? How does the new rules factor in?
So we all train our contractors now. So to be clear, in order to offer financing on our platform, you have to be trained usually by one of our sales managers. You have to take a certification exam, in addition to all of the background checking that we do before you're actually enabled to go and sell the product. So training exists now. I think it varies from provider to provider what that training looks like. What the new legislation in California is requiring is that it is now more of a standard form of training, something like 6 hours of training that each PACE representative or salesperson has to go through in order to be eligible to offer that. So that's certainly going to be an
Is that
increase.
training centralized or done just within the company?
I think that's still TBD. Currently, each of us do our own training. The idea is that there could be some centralized body that would offer this training and monitor the training so that for a particular contractor or salesperson to offer my financing versus my competitors, you wouldn't have to go through that 6-hour process twice. But again, I think this is all still being determined. Mm-hmm. We've had public comments at the Department of Business Oversight on these particular topics and sort of building that framework.
And let me add, from the accountant's point of view, as a provider of assurance reports and assurance to the market, there's always a trade-off between the cost of compliance versus the value of assurance, right? And I think that, let's use Regulation AB as an example, right? There was a lot of frustration, complaints. Look at all the additional costs that I'm going to have to incur to comply with Reg AB, the loan level data. It was a large change for many people in the securitization industry, inside and outside of the mortgage space. And yet the alternative was, if you didn't want to comply, do a 144A deal. And by most people's calculations that were, fairly mature and could issue large deals, the 50 to 75 basis points pickup on $1 billion deal was a pretty good value of assurance that offset the cost of compliance. And so I think that, PACE will go through the same kind of cost-benefited assessment. Mm-hmm. And I think that what we will find is if regulation and legislation done correctly, done in a way that is broad across constituencies and is not a patchwork quilt of, each stakeholder has its own regulation. But I think if done correctly, the value of assurance to the market and the growth that will provide via investor confidence, consumer confidence, government confidence is well worth the cost of compliance.
I would agree with you, Tom. I mean, again, I think visibility on the next year in terms of the costs of implementing these measures, particularly in April when we have to begin documenting the income. So now we're asking people if they can afford their assessments to provide us with some numbers that we can then run through and determine affordability. That will need to be documented beginning in April. So that's going to be a process both from a technology standpoint, from an extending the sales process standpoint. So this is going to require adjustment, and it's going to impact our volumes as a whole, as an industry as a whole.
But to be clear, it's not, the PACE originators didn't have to go from 0 to 60 here. Many of them, if not the ones that we've reviewed at Kroll, have done some version of this consumer protection. It's just a question of just filling in the gaps. I think the legislation came from just looking at the best practices from all the originators and just codifying them. So it was just they have to backfill where they don't have certain elements of the consumer protection, but all of them had some level of consumer protection. So it's not a situation where the people were going in blind. Some originators had to record phone calls. Some originators went so far as to develop groups that if the homeowner was 60 or above, they had a group dedicated to that particular, just to talk to that person to make sure they understood everything that's involved in the PACE origination. So it's not a situation where we're going from this, PACE is going from a rogue industry where that is going to be regulated, where people all of a sudden don't know how to go ahead and put these rules in place.
You're absolutely right, Cecil. I mean, as Tom or Steve said, I mean, we've been in industry for 9 years, and each year there's some additional legislation that gets passed here in California to add, again, additional layers of consumer protection. And as you said, ourselves and our competitors have also gone above and beyond what is even required by the existing legislation because it's important to us to protect consumers. And again, I think the one thing that is new in this these new laws in California is the documentation of income. So up until this point, that hasn't been a factor in the underwriting process and in the sales process. And when I say the sales process, so now, previously you could just get an approval based on providing a value for your income, running some numbers and coming up with an affordability calculation. Now you have to say, I need to see your pay stub, I need to see your W-2, I need to see your income tax return if you're an independent contractor. And so that's going to change our process, maybe extend the process, maybe cost some originations in the front end. We could see volumes decline this year because of these new changes, but again, in the long run, it'll be better for us as an industry as we grow more sustainably and maybe expand into some new jurisdictions.
Why would it necessarily hurt volumes of issuance? Because I like to argue, so you have to forgive me for a second. From another perspective, you could say, well, all of these changes basically protect the industry and the product, maybe not always for free, and there's additional assurances that we can get. Why isn't that improving the credit view of the product? Why wouldn't the credit ratings of PACE improve because of these legislative changes? And with improved credit ratings, you get lower cost and you reestablish your volume.
That's directed at me.
Yep.
Okay. Well, from a credit, we look at it. These are all good credit facts, obviously, from what is being proposed, what has been proposed, and what's going to be implemented come April 1st. But if you're looking at, I've gotten this question for the last, and I see all of the originators from different paces, leaning forward, waiting for my answer. Essentially, going from AA to AAA, at least from Kroll's standpoint, the FHFA overhang is the biggest thing, in addition to how the notes pay down over time. The notes pay down pro rata as principal comes in, and these are all 30-year bonds. So you're talking about some tail risk that the note holders have to take on in the underlying transaction. So if that tail risk was mitigated some way, somehow, then there's potentially AAA could be on the table, but in the FHFA issue having been resolved. But with respect to the underlying credit of the assessments themselves, we do feel that all of these things that are in the process of being implemented are all credit positives.
Sorry, I have a question in terms of, this is for James. How are you underwriting the borrower, and is it state mandated in terms of, a DTI has to be below a certain amount? Do you have to pull a FICO, things like that? I'm curious about if it's mandatory from a state regulation standpoint, or is this just like a best practice that you're taking on to differentiate yourself from the other PACE providers?
So the affordability question is one that's required by law. So again, now it's based on a stated income. And again, it's not a DTI per se, the way you would as in a mortgage. It's actually a residual income calculation. So we take, again, a value for the income, make some estimates for what the monthly expenses or annual expenses are for that particular borrower, and then come up with a residual income. And then that residual income has to provide coverage over the payment. So again, I think we all may do it slightly differently, but again, that particular framework was set up by the law. And again, what will happen is we've actually started, we've been doing that for a few months, even before January, and we're going to start, it's the sort of documentation aspect that will be new come April.
And you said with property tax increase, that's over 30 years you're going to see the property tax increase, is that correct? To pay for when a homeowner takes this on?
Sorry, go ahead.
Yeah, the financing can't exceed the useful life of the installation.
Okay. And how, on average, I know this is going to vary between states and regions, but on average, how much are property taxes going up per year for people that take on this program, comparatively to their neighbor?
The average,
same house and that,
yeah, the average installation that we've seen is around 25 to 30,000, and which results in about 2,000 to 3,000 of incremental annual taxes.
Okay, thank you.
But that's a good point. I mean, a lot of this legislation is around the fear that some poor older person is going to be tricked into a PACE deal and then evicted from their home. $2,000 or $3,000 a year difference is what we're talking about for something that they are getting that brings them significant value. This isn't a a loan shark thing. And additional requirements on well, let's talk about due diligence. What kind of due diligence is done on PACE?
So right now, from a securitization market point of view, the due diligence is really oriented around verifying the accuracy of the data in the prospectus and the disclosures to the investor. And so that's a matter of going from the tape or the list of assets in the transactions back to source documents and source data. That might be the system and records of the servicer or originator. That might be back to the actual documents itself that the homeowner signs. And so it's really about the ensuring the accuracy of the data that is ultimately disclosed to the investor. In terms of compliance with law, in terms of complying with those standards, there's I think a number of governments and taxing authorities that are thinking about, and some have acted on, what is our obligation as a taxing authority to oversee this program in terms of compliance. And I think that that's part of the discussion going forward, and part of the potential regulatory patchwork quilt that we've been talking about, which is who should be that body that oversees the compliance with law. I think the new legislation provides for a new regulatory mechanism, and I think that's probably the answer. But the details in terms of how that gets enforced, what kind of review is being done, how often, I don't think that we know those answers yet.
There's lots of effects going on. There's cost effects, origination volume effects, credit effects. I'm sorry we don't have a lawyer on the panel, but I am thrilled we have lawyers in the room who know about this. How much documentation is done, and does it now include a 1-inch thick truth in lending disclosure? What kind of documentation process? What is the documentation process?
So again, I
And
think
is it being slowed down, dragged down to the point where it could kill a product?
So I think that this dovetails with Tom's response. So again, what we spend our time in the origination process doing is putting together the primary documents that go into that loan tape and support that loan tape. And part of our practice is to make sure that, again, every homeowner, when they sign that assessment contract, understands the terms that they're entering into, understands that there's a lien that will be placed on their property that could impact their ability to sell or refinance a mortgage. And we have recorded phone calls, as Cecil pointed out, to document that. We do provide a form of a truth in lending statement. That was actually something that was prescribed in the legislation from last year, AB 1293, to kind of create a standardized truth in lending statement, a standardized 3-day right of rescission for the homeowner.
Why do you need a recorded call?
I mean, again, like everything, there's a long time frame. There can be a pretty long time frame between when a person closes their financing and when their first tax payment happens. It could be up to 18 months. So we find that a lot of customers will call, in November next year to say, my tax bill is more, and I'm wondering why. So it helps to be able to have that recorded call to say, you remember you installed these solar panels, you haven't been paying for them, it's on your tax bill, and here's you agreeing to them. I think that's the safest way to, again, make sure that everyone is going into a deal eyes open, and sometimes you just have to remind them that they're went into that deal eyes open 18 months ago.
Judging from an earlier question that I asked everyone if they were involved in PACE financing, we got a few hands raised. How many people here would consider PACE financing for an improvement to their home? Why? Why would you even do a PACE financing? Why don't you just do a second mortgage? Why don't you do credit cards? Why don't you do any of the other alternatives? What's so cool about PACE other than its very good and noble cause? You guys want to?
I mean, from my perspective, it's a classic win-win situation in the market. the homeowner gets access to credit fairly rapidly without having to do the lengthy process of a home equity line of credit takedown. So the process is more streamlined. It's a faster turnaround process. And you may not be interested in the speed of the process if you're installing solar panels, but if you live in Phoenix, Arizona, and your air conditioning system goes out, you're going to be interested in speed of financing. And so I think that it benefits the borrower from a simplicity, a streamlined, time to close, if you will, perspective. It certainly can benefit those borrowers that may not have an existing home equity line of credit, but would put the new HVAC system on their credit card at 15, 18, 20, 22% interest. So it can help consumers ultimately pay a lower interest rate on the financing. And so I think as we heard Cecil say, it can, you can have the term of financing up to the useful life of whatever the installation is. So if that's solar panel, that could be 30 years. If it's HVAC, it could be 20 years. And so you have a mechanism of financing from a term point of view that matches the underlying asset, if you will, that's being used to the house. So for me, from a term matching, from a rate, and from a simplicity and ease of process, as a consumer, that's why I would consider PACE.
Well, I'm glad you answered the question because I'm biased, but that was a perfect answer.
If I was a consumer in Las Vegas and I needed a new air conditioning system, how am I going to even find out about the option for PACE financing? How would I know?
There is no PACE in Nevada.
Okay, you know.
If we're being
I
factual.
stand corrected. If I was in California and I needed a new air conditioning system, how would I even know about PACE, or Missouri, or Florida, or any of the other states?
I mean, again, the way that we originate our business is through the contractor channel. So when your air conditioner breaks down, you're going to call an air conditioner repair person or someone to bring you a new air conditioner. And at that time, he'll show you that you can fix your broken air conditioner, or you can buy this new air conditioner that will cost less and is more efficient. And as part of that sale, you could either pay for it in cash, you can finance it with an unsecured line of credit or an unsecured loan, or you can use this other option called PACE. And so it'll happen at that level, at the contractor level.
The contractor will introduce it. So the marketing is really, the education is really the contractors to begin with.
Which is why we train them so much.
And then you're following up with education to the consumer on a recorded call, basically, right?
That's right.
Seems like a reasonable way to proceed. Would that make anybody in this room comfortable? It's just a call and a discussion on a recorded line. How does the public know that what PACE is a public-private partnership? How does the public know that there is a benefit that they have bargained for that's being delivered? How do we know that the new air conditioning system is 20% or 40% more efficient, and therefore it uses less electricity, and therefore less electricity needs to be produced, and the air is cleaner? How do we know that those energy savings are there, or the indirect benefit to the environment?
Sure. So again, in the statute that establishes these programs, there are sort of broad requirements on what you are, what will be eligible for financing. Broadly renewable energy, broadly water conservation, broadly energy efficiency, and then seismic retrofits as well in California. So in order to be eligible for financing, we have to have products that meet that requirement. So whether it's an Energy Star rating, whether it's a higher SEER rating than what your previous air conditioner had, so that we're looking to third parties to provide an independent measure that this is a more efficient product, this will be a more efficient product. And
Is
that's
there
how
a
you get
list of
approved.
eligible products, right?
There is, absolutely.
And in California, 900,000 items on that list, I believe?
It's a really long list.
It's a very long list. 900,000 items I couldn't make up off the top of my head. But that's how many items are technically qualified for PACE financing in California. What's the difference between PACE in California and PACE in Florida?
I mean, I think there are a couple of key differences. As Cecil pointed out, there is a use of proceeds difference in terms of in Florida, there's storm hardening as a resilience measure, as opposed to seismic strengthening here in California, not Nevada. There's a procedural difference in that the legislation in Florida actually requires a notice period before a bond can close and before a financing agreement can be signed, where, again, when the homeowner chooses to enter into PACE financing, they actually have to send a notice to their mortgage bank and allow that notice to be, to pass 30 days. So that creates a little bit of a different sales cycle in Florida than there is in California. And then lastly, the difference there.
Sorry, could you repeat? How does that lender consent work?
It's not a consent, it's a notice.
Notice, lender notice.
Right. So again, as part of the application and approval process, a notice will be sent to the lender, informing them that the homeowner is considering a PACE assessment or a financing agreement.
Is that to all lien holders on the real estate, or just the? I'm sorry. Question for James: is that to all lien holders on the property, or just the first lien
I
holder?
believe it's just for the first mortgage.
Just the first mortgage. Thank you.
And then I think the last key difference in Florida versus California is this, there's a mature tax certificate, tax lien sale business in Florida. So that's usually the form of remediation for a delinquency in Florida, as opposed to the judicial foreclosure process in California.
Okay. So this PACE financing starts in California. It's approved in 33 states and the District of Columbia, most of whom have done nothing. Some of whom have done things like, well, obviously California is the lion's share of the market, Florida, Missouri. What is the current volume of PACE financing? I mean, the problem with PACE historically is these critical mass issues. How much PACE financing was done in the last year? $1 billion? $3 billion?
Well, the 20 deals that we've rated, that accounts for about $4 billion since 2014, and that's up almost 140,000 assessments in that same amount of properties. So it's not a small market.
And will the market double in 3 years?
Craig, Rasul. There we go.
I think the market is going to take off pretty dramatically because there's now capital available for these assets. I think we have a long way to go in terms of education, whether it's with contractors on the residential side or the way we approach commercial PACE. We have a ways to go, but I would say the market will at least double in the next 3 years, which means these assets will be coming more and more often into the capital markets through securitizations and private placements.
I agree, and I think that you've pointed out some of the headwinds that we still need to solve. The agency overhang is still a headwind. That's not going to go away anytime soon. But I think that, because at the end of the day, if a state has adopted a friendly set of PACE legislation, business-friendly piece of legislation, it's then into the local taxing authorities to adopt and oversee a program, hire a program administrator. And getting back to my comments before in terms of the financing mechanism being a win-win, one of the reasons I'm optimistic for growth is if you're a council member on one of these local taxing authorities and you have the opportunity to bring in a public-private partnership that, one, allows homeowners to have access to credit at lower rates, if you have the ability to say that you're supporting small local businesses in terms of your contractor network, if you have the ability to say that you're improving the environment and you're helping your local, city, town, county, whatever, meet whatever green goals that they might have, whether that's water conservation or, energy savings, This allows those legislators to, check multiple boxes in terms of their agendas and to be able to promote, their success and in terms of leading and guiding their local organizations. So I think that, that's one of the things I'm optimistic about is that, when local governments see how this is a win for other communities, even given the regulatory headwinds, I'm optimistic for growth.
Can PACE financing through a local government cause higher taxes just because of the cost of government? How much does this cost the government to partner with us? Is it cash flow positive or cash flow negative? They get fees, right?
Yes.
This is cash flow positive for the government. So say one of you in this room decides to run for governor of your state. This would be a very positive message to be sending to say, we're going to improve the environment, we're going to make financing available that otherwise hasn't been available, we're going to bring in capital markets cost of funding, and it's cash flow positive for the government. How do you not campaign with that? I mean, it's beautiful. The most recent state to approve legislation was Illinois, where Governor Rauner is fighting with just about everybody. But he is certainly supporting this, and there's not a lot, it's passed. Anything that got passed in Illinois to me is a near miracle under the current political circumstances. Yet this got passed. This is the chance for all of the lawyers and investors and issuers and administrators to actually, for the first time in our careers in finance, say, we're helping the environment. We actually get to wear white hats on this one. It's great. I don't know if every financial product can boast that. We are bringing real energy efficiency through finance, better environment through finance. It's a very powerful thing, and it's cash flow positive. It's cash flow positive. We don't have much time left. Are there any other questions? Yeah.
That was a little hard to follow there, Steve, in terms of a prequel. But my question is, when you say Florida is approved, is that the entire state, or are you talking certain parts of Florida, counties?
Is it federal, state, or local?
So, like in
Or all of
California,
the above?
it's a local program. So we have a JPA that we work with in Florida. So that's the first part.
Can
of
you
the
say
puzzle.
what a JPA is?
So a JPA is a Joint Powers Authority. So again, it's this quasi-governmental entity that can levy the taxes. But then once you have that program established, you have to go city by city, county by county, and have each of those individual jurisdictions join your program.
So is the city of Los Angeles participating in WRCOG's program? How many, if California is the mothership of this industry, how many programs are there in California?
At least
I think
five,
the
can
answer is
think of.
as many taxing districts as there are in California. I'm guessing that's the answer. But isn't that the real challenge for PACE, is how there's been a lot of talk about regulation, which I think is consumer regulation, which if you're doing consumer lending, you deal with this every day. But the real governmental challenge is, doing anything locally, I would imagine, just takes a lot of time and money. So how does PACE address that? It seems to me it's going to be a slow go.
I mean, again, the process in California has been going on for 8 or 9 years, right? It's hand-to-hand combat at the city council level, at the county board of supervisor level, finding the right staff person to make the presentation to, finding the right person to kind of shepherd these resolutions to go before the city council. It could take 3-6 months in some cases a couple of years before you can get a particular jurisdiction, to join.
Through your network of engineers or people who put this stuff in, do you sort of get as a customer? And if not, like, where do they go? Do you refer them? Is that another opportunity to, if people aren't going to, they decide PACE is too complicated, they're going to turn and get some other secured or unsecured lending?
Sure. I think that's exactly right. I mean, you'll find any good home improvement contractor has a couple of different financing options available to him, right? He has his Green Sky or his Synchrony unsecured. He has, probably one or two PACE options, maybe more. Because again, as you said, PACE is very jurisdiction, so you might be able to use us in one city but not in another. So you can't not get to a place and not have a PACE option. So again, that's something that they manage on their own in terms of, the 2 or 3 people they want to work with.
And could you please just address, if somebody does have a PACE loan on their home and they go to sell, have there been issues? Have they had trouble selling the house? How has that affected people when they're trying, to unload the house with higher taxes? And of course, it depends more on region and your neighbors. So
Well, with higher taxes and a roof or an air conditioning system or any of the other PACE purposes.
I mean, what we've seen in the information that's provided to us from the PACE originators is that to get an FHFA loan, if it's going to be refinancing or it's going to be a sale, the FHFA is requiring that the PACE lien gets extinguished. So prepayments are on the order of 12 to 15% in the ABS deals that we currently rate, and 2/3 of that is a result of what I just described. So I wouldn't say necessarily creates any illiquidity in the sale of the home. It just creates prepayments, which are, again, credit positive from how we rate the transaction.
And again, importantly, we charge no prepayment penalties. Someone can prepay their assessment or their financing at any time. As Cecil said, you may have an assessment on the property because there's a roof, but, if I'm buying your house, I want you to pay for the roof before I pay you. So I think that it also just comes down to a negotiation between a buyer and a seller. And again, oftentimes you'll just have that prepayment, even though that assessment could technically transfer from the buyer to the seller, or to the seller to the buyer.
So if there's I guess, how does that work from a mechanism viewpoint? You're buying a house with a PACE loan. It requires prepayment. Do you just you can't get financing for it, so I guess, how does that work intuitively?
I mean, again, most of the prepayments that we receive will come from the trustee bank. So again, as part of that deal, this is one of the line items where they're going to send a wire to us to pay us off. As part of the sale, it comes out of the net proceeds of the sale.
And then the prepayments, what are they, the prepayment penalties, what do they look like?
There are no prepayment penalties.
Okay.
What, last question.
I didn't understand. There's a homeowner who has a first mortgage on their property, as opposed to a homeowner who doesn't have a first mortgage. Now, with the mortgage agreement, there are sometimes requirement for consent to take certain steps with a mortgage property. How does that relationship with PACE and a first mortgagee working out as it relates to consent to do anything with the property?
There's no consent obtained on the residential side. On the commercial side, that's the function of the commercial PACE originator, where they would notify the commercial lender, or they'll obtain consent. But on the residential side, no consent is actually obtained.
Okay,
so the question really is then, are mortgage companies happy with the PACE business?
Well, no, they aren't. Okay. You see that from realtors and FHFA. This is the reason why the prepayments are generally so high relative. If you want to compare this to a traditional RMBS deal, CPRs and RMBS deals are generally 5 to 7%, and PACE is twice that from a CPR standpoint. So that's resulting from the fact that if you have a refinancing or a home sale, the FHFA is requiring that the PACE assessment be paid off in order to get a guaranteed mortgage that's attached to the refinancing or the home sale.
We're out of time, so we're going to stop here. Thank you for being the best audience at the best panel in the entire conference. And with that, travel well. Thank you.